Hello. Let's take a break and stop doing whatever you are doing. This is Asian Money Guy, and it's February 4th, 2026. So let me start the way I'd start this if you and I were just sitting across a table with coffee and you asked me, what the hell just happened last week? I'd tell you this: something broke. Not in the markets are down way. In the plumbing didn't behave the way it's supposed to way. And if you don't understand what happened from Wednesday, January 28th through that weekend, you're going to interpret the next move wrong. And when people misread a system shift, they don't lose a little. They lose big. Because what we saw wasn't your standard pullback. It wasn't profit taking. It wasn't even a clean crash where you can point at one event and say that's the reason. It was a signal. And the reason I'm calling it a signal is because it fits a pattern that's older than modern finance. This pattern shows up when a reserve currency system starts to wobble. And once it starts wobbling, it doesn't calm down on command. It calms down temporarily, and then it comes back louder. Now, I'm going to give you some numbers not to sound dramatic, but because numbers keep you honest. On Thursday, January 29th, Microsoft lost around $357 billion in market value in a single day. That's a wild sentence to say out loud. But here's the thing: that still wasn't the main story. The main story was what happened in safe assets. Gold ran to a historic high near 5,680 on Wednesday, January 28th, and then it got slammed down double digits in less than a day as leverage and margin dynamics took over. Silver didn't slide. It moved like a high volatility instrument. And the dollar, the reserve currency, dropped roughly 3% against major currencies in about 2 days. Now, if you don't track currency moves, let me translate that. For a reserve currency, that's not a blip. That's the kind of move that makes serious people quietly sit up straighter. And here's where it gets interesting, because this is the connection most people don't make. On January 28th, the Federal Reserve held its first policy meeting of the year, and the tone was not what markets were leaning on. Inflation wasn't declared defeated, and the sense of easy money comfort wasn't handed out the way people expected. At the same time, political pressure to cut rates was getting louder, publicly louder. And then, almost immediately, you started seeing something even more important than stock volatility. Foreign institutions and governments signaling discomfort with U.S. debt and U.S. fiscal stability. Not just whispering, saying it out loud. When foreign holders start openly questioning the thing that's supposed to be the foundation of the global system, you don't brush that off as news cycle noise. That's the base layer getting tested. Now zoom out again, because the math is the part everyone tries to avoid until it's too late. U.S. national debt reached about $38.43 trillion on January 7th, 2026. That's roughly $2.25 trillion higher than a year earlier. The rate of increase works out to around $8 billion a day, every single day. And interest costs hit about $1.2 trillion in fiscal year 2025. At that point, you're not just servicing debt. You're feeding a machine that grows faster than the economy that's supposed to support it. You are borrowing to carry the cost of borrowing. That's not politics. That's physics. So with that on the table, I want to talk about the pattern, and I'll keep it conversational. If you go back across history, every time an empire controls the reserve currency, it moves through a similar 4-stage cycle. Stage 1 is trust, real trust. The currency works because it represents something real: productivity, power, stability. People want it, they save in it, trade runs through it. Stage 2 is temptation. The empire realizes it can fund things it can't afford because everyone needs its currency. So it runs permanent deficits and fills the gap with debt and money creation. And because it's the reserve currency, it exports the consequences. Inflation gets delayed, the system looks strong, people feel rich. It feels like a cheat code. Stage 3 is the awakening. The math becomes impossible to ignore. Confidence cracks. Foreign holders start questioning whether they want to hold reserves in a currency that's being diluted. The system gets jumpy, markets get unstable, and then you get events that look random on the surface: a shock, a policy surprise, a sudden break that expose how fragile the setup has become. Stage 4 is the reset. The rules change. Either the currency devalues structurally, or a new system replaces it, or reserve status shifts to something else. And when that happens, wealth doesn't disappear, it moves. From paper claims in the old denominator into things that survive in the new world. Now, I'm not saying this to be theatrical. I'm saying it because this pattern is documented. Rome debased its currency for decades until it stopped being money in any meaningful sense. People who held the old coin got wiped in purchasing power. People who held land and productive assets survived. Weimar Germany printed and printed until a lifetime of savings couldn't buy bread. People who held cash got annihilated. People who held real assets, businesses, land, foreign currency, they survived, and in many cases became wealthier in relative terms. Britain's pound lost reserve dominance after the strain of wars and spending, and wealth flowed toward the new center of gravity. It wasn't overnight, but it was irreversible. Different centuries, different systems, same rhythm. So now, let's bring it back to the United States and what happened last week, January 28th to January 31st, 2026, because that window matters. It wasn't one headline. It was the combination. A central bank message that didn't calm markets, rising political pressure, a sharp repricing in risk assets, and then a violent move in safe assets that looked less like fundamentals changed and more like leverage got squeezed. That's what stage 3 looks like in the modern world. It doesn't announce itself with a siren. It shows up as volatility that doesn't make intuitive sense because the system is shifting underneath. And here's the key distinction I want you to hold on to, especially in a podcast format, where you can actually sit with the thought. Currency is not wealth. Currency is the measurement. Wealth is the thing being measured. When the measurement becomes unstable, people who confuse currency with wealth get trapped. They think a number in an account is safe, even as the unit itself is being diluted. And then they wake up one day and realize they did everything right and still lost purchasing power. So what does stage 4 mean? It doesn't automatically mean apocalypse. It means reset. It means the system reprices what is real and what is paper. And historically, that's where the big wealth transfer happens. And now we're at the part that matters most. What do you do with this? Not panic, not doom scrolling, not YOLO trades. You do what adults do. You study what preserved wealth in prior resets, and you stop pretending the old rules are guaranteed. Hard assets have survived every reset in recorded history because they can't be printed. Productive assets survive because they generate value. Diversification across systems reduces concentration risk. And skills, real skills, are the ultimate hedge because they can't be inflated away. I'm not telling you to run out and buy anything on command. I'm not giving you investment advice. I'm giving you a framework that's been tested by centuries, because history is the only backtest that matters when systems change. So here's the question I want to end on, and I want you to actually sit with it. If the last week was a stage 3 signal, not the event, but the signal, are you positioned like the old system is permanent, or are you positioned like history is real? Because the pattern doesn't wait for your emotions. It doesn't pause because the headlines feel overwhelming. It accelerates. If this episode helped you connect the dots, subscribe, because the next one breaks down what a stage 4 defense framework looks like, not hype, not fear, just a practical way to think when the measurement system itself is unstable. Ladies and gentlemen, let's get something straight right at the top. Because a lot of people are finding this out the hard way in 2026. You don't own access to cash the way you think you do. You own a claim on money inside a banking system, and when you want to convert that claim into physical bills, you're stepping into a world that's not run by customer service, it's run by compliance. And that's why so many normal people are walking into banks lately and feeling like something is off. Like the teller is suddenly colder. Like the questions are sharper. Like the process is slower. Like the vibe is, why do you need your money? Now, I'm going to say something that's going to calm the noise down, and then I'm going to tell you what should actually worry you. There is not some new nationwide federal rule that automatically reports every cash withdrawal over 10 to the IRS. The long-standing federal threshold for a bank filing a currency transaction report of CTR on cash activity is more than 10-0 in a single business day, including withdrawals. That is still the core rule. So if you've been seeing viral clips screaming 10 triggers automatic reporting now, you need to understand that's not how the main federal CTR rule works. But here's where people get blindsided. Because the thing that's changing lives is not the clean 10-0 rule. It's the part of the system that's deliberately fuzzy. It's the suspicious activity report world SARs. SARs aren't triggered by one nice, neat threshold that you can memorize and forget. SARs are triggered by patterns, behavior, and whatever a bank's monitoring system flags as unusual. And that's why people feel like the rules changed, even when the headline threshold didn't. Because in real life, here's what happens. A lot of banks have automated systems that watch cash behavior and ask a simple question: does this look like someone trying to avoid reporting? That's where the word structuring comes in. Structuring is the act of breaking transactions up to evade reporting requirements. And yes, that's a real concept in federal law. Now let me give you the human version of what that means. Imagine you're a small business owner. You pay a contractor in cash sometimes. You pull $900 on Monday, $800 on Wednesday, $700 on Friday. In your mind, you're being careful. You're staying under a line. But in the bank's monitoring world, that can look like a pattern. And here's the part nobody tells people. Banks don't owe you a warning that you're being flagged. They don't send you an alert saying, hey, your activity looks like structuring. They simply log, review, and escalate internally if the pattern trips their risk logic. So what do people experience? They experience friction, they experience questions, they experience delays, they experience that feeling of, why am I being interrogated? And that feeling is what's spreading right now because the system is built to treat cash as a risk category. Now, let's talk about the second layer, the one that's making people even more uneasy. Even if you're not near 10-0, even if you're not doing anything wrong, banks can still slow you down because cash is not just a number on a screen. Cash is physical inventory. Branches have limits, ATMs have limits, cash deliveries get scheduled, call ahead becomes the standard phrase. And it's always framed as safety or operational logistics. Sometimes that's true. But here's what's also true. In a world where the financial system is more leveraged, more automated, and more sensitive to risk, banks are incentivized to minimize anything that creates compliance exposure or liquidity stress. So, yes, the average person might not get blocked. But the average person can absolutely get slowed, and that slowing feels like a warning sign, because it is. Now we get to the real question. What is the system moving toward? It's not cash is illegal. It's not you can never withdraw money again. It's something quieter and more powerful. Cash becomes inconvenient by design, while digital becomes the default. That's not a conspiracy. That's just where the incentives point. The government wants traceability. Banks want risk reduction. Payment networks want volume. Fraud systems want control. And the public wants convenience. And when all of those forces line up, you end up with a world where cash isn't celebrated as freedom, it's treated as a problem to manage, which means your relationship with money changes. Because in a cash world, if you have bills in your hand, you can transact without permission from a network. In a fully digital world, every transaction is mediated, approved, screened, risk scored, and if any layer decides no, you don't get a debate. Your card declines, your transfer freezes, your account gets reviewed. Most people have already tasted that in small ways, a fraud lock, a transfer hold, a come into the branch with ID. But what happens when that becomes normal? That's what people are sensing. Now let me be really careful here, because I'm not trying to scare you. I'm trying to make you prepared. So here's the practical reality, and I'm going to say it like I'm talking to one person listening in their car. If you know you'll need cash, plan ahead. If you operate a legitimate cash business, document like a professional. And whatever you do, do not play cute games trying to stay under thresholds, because that is exactly the behavior banks are trained to view as suspicious. The safest approach is boring. Be transparent, be consistent, have a real reason, and don't act like you're trying to dodge the system. Because once you look like you're dodging, you can get pulled into a compliance machine you didn't even know existed. And I want you to hear this part clearly. Compliance review doesn't require you to be guilty. It only requires you to look unusual compared to your own history. That's why people get surprised. They don't realize modern banking isn't just money in, money out. It's profiles. It's risk scores. It's patterns. Now, why does this matter right now, in early February 2026? Because we're in a period where people feel financially squeezed, uncertainty is high, and trust in institutions is lower than it's been in a long time. When that happens, normal people start wanting optionality. They want flexibility. They want to know they can access their money if something goes wrong. And the uncomfortable truth is, the system doesn't want everyone testing that at the same time. That's not a statement about an impending collapse. That's just how fractional banking works. Structurally, banks are not built for everyone to demand physical cash immediately, all at once. That's why the system is designed to smooth and manage behavior. So if you've felt that friction lately, you're not imagining it. But if you've been told a simple viral line like 1-0 automatically gets reported, don't fall for the cartoon version of the story. The real story is more subtle and more important. The rules that matter most are the ones that are vague, pattern-based, and bank-enforced. And those rules are already here. So here's how I'll end this episode, and I want it to land. Most people think control looks like a big announcement, a new law, a dramatic speech, a headline. Real control looks like a user experience change, a delay, a limit, a call ahead, we need to verify, we can't do that today. And by the time everyone notices the pattern, they've already accepted it as normal. So the takeaway is not panic. The takeaway is awareness. Know how the system actually works. Know what triggers attention. And don't wait until an emergency to figure out what your bank will or won't do. Because the people who get trapped are not the criminals. It's the people who assumed the old world rules still apply.